In this video, I'm going to be sharing with you the 5 important hacks that you must know if you want to make consistent profit with crypto trading, or if you want to make as much as you want with crypto trading. Now, if you understand these 5 important hacks very well, you can make as high as $100, $1,000, $10,000 every month, depending on your trading capital. Now, out of these 5 important hacks I'll be mentioning in this video, number 4 and number 5 are the most important ones, especially if you want to do futures trading. But you must first understand number 1, number 2, and number 3. So if you are ready for this video, please like this video and please subscribe to my YouTube channel if you are new to the channel. Now, before I go into these 5 hacks, there's something important that you must understand about crypto trading, especially futures trading. So this video is mainly focused on futures trading because that's where you can make the highest money in crypto, and also that's where you can lose the highest money in crypto. So you need to understand it very well before you can jump into futures trading. Now, like I was saying, one important thing you need to understand about futures trading is technical analysis. Without a very good analysis, you cannot make consistent profit with crypto trading. That's just the truth. You cannot be doing futures trading by just guessing where the market will go, by guessing whether it will go up or down, and you think you'll make consistent profit. It will never happen. And that is why a lot of beginners always lose money. Recently, I've seen a lot of people coming to my DM complaining about making losses. And one of the reasons why you're making losses is because you're not doing good technical analysis on the chart. So these 5 hacks I'm about to share with you are basically the 5 things that are very important under technical analysis, especially for beginners. So if you're a beginner, this video is for you. With these 5 hacks I'll share with you in this video, you'll be able to do your technical analysis very, very well and be able to make consistent profit from your trades. Or if you're not making consistent profit, you can get higher win rate from your trades. I hope you understand. Now, the first important hack is understanding key levels. Now, when it comes to trading, we have key levels such as your support and your resistance. Now, these 2 key levels are very, very important if you want to make consistent profit with futures trading. Now, what are the key levels, or what do I mean by support and resistance? Now, support and resistance are key levels on the chart where you have multiple rejections. Now, in case you've been watching my videos for some time, you should understand support and resistance right now. But if you are just new here, or maybe this is the first time you are watching a video like this, then I'll show you how to draw your support and resistance. Now, in case you understand support and resistance already, you can still watch this because you will learn something from what I'm about to show you in this video. Also, I still have 4 other hacks to show you in this video. Now, how do you draw your support and your resistance? Now, to do that, it is very simple. Now, for some people, they always use straight lines to draw their support and resistance. But for me, I always use rectangles. And my students know that. I use rectangles to draw my support and my resistance. So I will draw it right now and I will explain to you what the support and resistance are doing, or how they are helping you on the chart. So this is the TradingView website, and to pick your rectangle, just come right here to the left side of the screen. You come here to where you have this brush icon, just click on the small arrow beside it, and then you see where you have rectangle right here. So I'll click on it, and then I'll draw it, and then I will be able to explain to you what I mean by support and resistance. So let me just go ahead and draw the support and resistance. So that's one, and then I have another one right here. I'll explain to you how I'm able to locate the key levels. And then I have another one right here also. So I can be able to move this right here. Let me just move it here. So these are my key levels. So I think I still have one more here. Let me draw one more here, right here. These are important key levels on the chart. So let me make the screen big so you can see everything very well. Now, as you can see on the screen, I have 4 key levels right here. Now, what are the key levels on the chart? Now, the key levels are the levels on the chart where you have multiple rejections. Now, what are the multiple rejections? Now, let me look at, if you look at the screen right here, you see that, let me use my trend line. You see that from this point, so let me start from this point. You see that from this point, the market was going up and the market got to this point. Now, after the market got to this point, the market moved down to this point. And after I got to this point, it moved up again. And after it moved up again, it moved to this point right here. You can see it. Just be watching as I'm moving. Now from this point again, it moved right here. And then it moved there again. Just watch as I'm moving. So I'll be moving this fast right now so that I won't waste our time. So as you can see on the screen, I've used my trend line to show you how the market has been moving. So let me explain to you how I was able to pick the key levels. Now, like I said, the key levels are the point where you have multiple rejections. So let me use the arrow to show you the multiple rejections. So I'll select my arrow. To select your arrow, come here to where you have this rectangle icon, click on it. You see where you have this arrow down. So let's use the arrow down one. Now, as you can see right here, the market was moving up, and when it got to this point right here, it was rejected. So let me put my first arrow right there. What does it mean to be rejected? That means the price did not go up. It reversed back to the opposite direction. So from this point, the market started moving down. So as the market was coming down, when it got to this point again, this area here, it moved back up. So let me put another rejection right there. So let me put the arrow up. So this is the arrow up right here. So you can see. And then at this point, it just moved up and then it came back to meet this area right here. So this is under rejection right here. So let me put it. So we have under rejection. That is the market or the price moved back to the other direction. Now, when it got to this part right here, this is under rejection. So it came back up. So let me put the arrow down right there. So this is the arrow down. Yeah. And then it came back to this same level that we had the previous rejection. So you can see on this same level we had under rejection. So it came back to that same level again. So I'll put another arrow right there. And then the market started moving up again. And then it came to this area right here again. This area where we had multiple rejections. So you can see we already had 2 rejections on this area right here. This 1 and then this 2. So it came back to this same level again. So I'll put my arrow there again. And then the market started coming down, and then the market came to form another rejection right here. So this is the first rejection on this line. So on this line right here, this is the first rejection. So I'll come and put it right here. We have another rejection. So this is it. And then the market started moving up and was rejected at this point again, where we already had 2 previous rejections. So you can see we had 2 previous rejections on this line, and then another rejection came to happen again. So I'll put another arrow right there to show you. So that will be the arrow down. Now, so as not to waste our time, I'll just put the arrows and then I'll show you. So these are the other arrows right here. So let me move it so I can show you the remaining ones. So this is another rejection. This is another rejection. And then right here is another rejection. This is another rejection right here. Then we had another rejection right here. And then you can see we had multiple rejections. So we have another rejection right here. So that is basically what it means to have rejections on the chart. Now let's look at what I mean by having multiple rejections on a line. Now if you look at this first one right here, this first line or this first key level right here, we have 2 rejections right here. This is 1 and this is 2. Now, if you come to this second one right here, how many rejections do we have here? We have, this is 1 right here. This is 2. This is 3. This is 4. This is 5. This is 6, 7, 8. We have 8 rejections right there. And then you can see this third line right here. We have multiple rejections again. We have 1, 2, 3, 4, and 5. And on this last one, we have 1, 2, 3, 4. That's 4 rejections right there. So any line where you have multiple rejections, that's your key level. Now for the key levels, I said we have 2. We have support and resistance. Now your support is at the bottom while your resistance is at the top. So that means that your resistance is this one at the top right here, and then your support is the one at the bottom. But what of these 2 in the middle? Are they support or resistance? Now these 2 key levels at the middle, they can be called support and they can also be called resistance at the same time. So again, I said the one at the top is resistance, the one at the bottom is support. Now let's, for example, you are focusing on doing analysis between these first 2 key levels, that is this resistance and this line. Then if your analysis is between here, that means that the one at the top is your resistance and this one right here, this second line right here is your support. That's the meaning. But let's say, for example, your analysis is between this middle 2 lines, that is this line right here and this line right here. Then this line at the top is called your resistance, while this line right here is called your support. But let's say, for example, you want to do analysis between these last 2 lines, then this one at the top is called your resistance, while this one at the bottom is called your support. So wherever you are doing your analysis, the one at the top is resistance and the one at the bottom is support. That's just the simple meaning. Now, this is the first arc you must be able to understand very, very well. In as much as you can be able to draw your support and your resistance, every other thing will be simple because almost every other thing under what I'm about to explain to you depends on how you are able to draw your support and your resistance. And by the way, if you want to learn how to use support, resistance, and trend lines to create a strategy for you to make at least $100 every day for yourself with crypto trading or futures trading, then I have a video on that. The link to that video will be in the description below. In that video, I explained more about support and resistance and how you can also add trend lines to be able to create a strategy for yourself to make at least $100 every day. Again, the link to that video will be in the description below. So once you're able to understand support and resistance, which I've just explained, the second act to be able to make consistent profit for yourself is to understand candlestick patterns. This is one of the things you must understand in crypto trading. You must understand candlestick patterns. There are some people who don't use candlestick patterns to trade and they're still making their profit, but for me, I always use candlestick patterns and it has been helping me. Since the very first day I started using candlestick patterns, I've been seeing a higher win rate in my trades, and that is what I use in creating signals in my signal group. And by the way, if you want to join my signal group, the link to join is in the description below. Now, candlestick patterns are basically what will show you the way the market is moving on the chart. So there are things that can help you create a strategy to trade on the chart. Now, we have almost 100 candlestick patterns out there, but I won't advise you to go and be learning 100 or almost 100 candlestick patterns. That's not possible. Just focus on learning at least 6 to 10 candlestick patterns and you are good to go. Now, in case you are looking to learn candlestick patterns, I have some examples I'll give you so that you can go and learn. The first one you must learn is double top and double bottom. These first two candlestick patterns are very easy to identify and can help you make consistent profit. The second one is the head and shoulder candlestick pattern or the inverted head and shoulder candlestick pattern. This is also very simple to know. And the third one is the flag pattern. For the flag pattern, we have the bullish flag pattern and we have the bearish flag pattern. All of these you can learn in my complete crypto trading course. Now, as you can see on the screen, this is one example of a candlestick pattern. So I will explain using this double top and double bottom candlestick pattern. So I'll be using this candlestick pattern as an example to show you how candlestick pattern works. So the way this works is the way other candlestick pattern will work. You just need to identify the movement of that candlestick pattern, which I will explain to you in this video. So for example, this is the double bottom candlestick pattern and then this is the double top candlestick pattern. What is the meaning? As you can see right here, you can see the market was moving down at this point. So check this is it. The market was moving down. And then when it got to this point, the price was rejected. So this is a rejection. Remember what I said rejection was when I was talking about support and resistance. So this is where you have rejection right here. So instead of moving down, it was rejected and then it moved back up. Now at this point, it came down again and came to that same level. This same level it was rejected. It came back to be rejected again and then it moved up. Now after moving up, it broke this neckline. So this is a neckline right here. This line is called a neckline where they meet at this bottom right here. So when it is moving back up right here, if it breaks this neckline, it means you have a confirmed bullish trend. That means the market is going up, as you can see right here. Now for the double top, it is the opposite of the double bottom. So right here, from this point, the market was moving up, and then when it got here, it was rejected, and then it moved back down, and then came to this neckline, and then from this neckline, it moved back up again, and then it was rejected at this same level. You can see it was rejected here. So at this level again, it was rejected again, and then it moved back down. And while moving back down, it broke this neckline. So after breaking this neckline, that means you have a confirmed bearish trend. Now let's look at the chart and see some examples of these candlestick patterns. Now, as you can see on the screen, these are the support and resistance levels I drew earlier to explain support and resistance. So I'm going to be using them to show you the candlestick pattern so that you'll be able to see that these candlestick patterns also depend on the key levels. So that's why I said you must be able to draw your key levels very well. So let me show you the double top and the double bottom candlestick pattern. Now look at this point right here, this area on the chart. So let me put a circle so you can be able to see what I'm talking about. So to select the circle, so you can just come right here to where you have this arrow, click on it. You see where you have circle right here. So let me show you, this is the part I'm talking about. Let me just, so that you can see the part I'm talking about. This part on the chart is where I'm talking about. Now, what candlestick pattern are we having right here? At this point, we have a double top candlestick pattern. Now, if you look at the circle area right here, you can see them from this point right here, the market was moving up, and then the market got to this point right here and was rejected. So it got here, it was rejected and came down. When it got to this point right here, it got rejected again and then went up again. So as you can see on the screen, when the market was coming down the second time from the second rejection, it did not come to break this neckline at all. Instead, it went back up again and was rejected at this point, and then came down to come and break the neckline at this point. So after breaking this neckline right here is when you can now say you have a confirmed bearish trend. That means the market is moving down from this point. And you can see on the screen, it went really down. So you can see it went really down to this point. So if you are trading, whether even scalping or swing trader or day trader, you can make a lot of profit from this breakout right here to this point right here. So you can see combining candlestick patterns and support and resistance has really helped in this point right here. Now, some of you might want to say, but I said it's double top candlestick pattern. So why am I having another rejection right here, making it 3 before coming to break this line right here? Now, just like we have the double top candlestick pattern, we have the triple top candlestick pattern. And just like we have the double bottom candlestick pattern, we have the triple bottom candlestick pattern. But for me, I'll still say this is still a double top candlestick pattern. Let me show you. So let me delete these trend lines that I've used in drawing right here. so that I can show you that this is still a double top candlestick pattern. So let me show you. So I'll just select my trend line right here, and then I'll select from this point, the market was moving up to this point. So you can see it moved there. And then the market came to this neckline right here. And then from this neckline, it moved up again to this point. And then from this point, it moved here to this neckline. And from this neckline, it broke this neckline. So you can see that it is still a double top candlestick pattern. And a double top candlestick pattern is the one that is forming a letter M. So you must take note of that also. So you can see I've just shown you it's still a double top candlestick pattern. It's moved up to this point, came down to this neckline, moved up to this point, and then came to break this neckline. So after this neckline is where you can now say you have a confirmed bearish trend, and then you can now go on to short, and then you can make your profit. So you can see right here. Now, the second candlestick pattern which I just explained is the double bottom candlestick pattern. So let me show you an example. Now, as you can see on the screen, this area is where we have the double bottom candlestick pattern. So let me draw the circle there again so that I can show you. So this point is what I'm talking about. This is where we have the double bottom candlestick pattern. So I removed the trend line. So let me draw it again to show you how the market was moving. Now you can see right here, the market was coming up right here, and then it came down to touch this point right here. Now, after coming to touch this point, it went back up to this point right here. And after coming back to this neckline right here, it came down again to this point. And after reaching this point, it came down again to this point. But when it got to this neckline, it broke this neckline and went to the top. So this is an example of a double bottom candlestick pattern because you have two bottoms right here. So let me move this right here. So this is the first bottom right here, and then this is second bottom right here. So you can see it's forming a letter W. So double top bottom will form a letter M, while double bottom will form a letter W. So you can see right here, combining support and resistance with the double bottom candlestick pattern will help you know when you have a bullish trend and a bearish trend in the market so that you can take your decision with your trade. Now, aside from the double top and the double bottom candlestick pattern, like I said, we have multiple candlestick patterns out there that you should learn. We have the bullish flag and the bearish flag candlestick patterns. We have the head and shoulder candlestick patterns. We have the inverted head and shoulder candlestick patterns. We have a lot more candlestick patterns that you should learn. And all of these, you can learn them in my complete crypto trading course. So once you understand candlestick patterns, the third arc you need to understand is time frame. So let me go to a clean chart so I can explain this. Now, time frames are very, very important when it comes to crypto trading. Now, how do you identify or where do you pick your time frames? So if you come to the top of the screen right here where you have this 30M, just click on it. You'll see the different time frames you have right here. Now, you can see you have 1 second time frame, 5 second time frame, up to 1 minute time frame, 2 minute time frame. You still have 1 hour time frame, 2 hours time frame, and so on. Now, some of you always make the mistake of taking this time frame in another direction. So for example, if I'm using 30-minute time frame right here, some people always think that if you're using 30-minute time frame, that means once you enter your trade, you must close your trade within 30 minutes. No, that's not the meaning of time frame at all. For 30-minute time frame, it means the candlesticks are showing you how the market is performing every 30 minutes. That's not the meaning. Or if you come right here and change it to 1 hour, so let me change it to 1 hour time frame. What it means is that the candlesticks are showing you how the market is performing every 1 hour. That's just the meaning. And the candlesticks will have different arrangement for every time frame you pick. So if I pick, let's say, one more time frame right here, you see that it will change. So you can see the direction has changed. So it will definitely change right here. So you can see it. You see it has changed right here. But let's, for example, I go back and pick, let's say 2-minute time frame. It will also change. So you can see right here. So let me change it back to 30-minute time frame. So again, 30 minutes means that each candlestick is showing us how the market is performing every 30 minutes. Now, for you to confirm what I'm saying, let me make this big so I can confirm what I'm saying, that each candlestick represents what the market is doing every 30 minutes. Now, if you look at this candlestick right here, this candlestick, let me still make it big so that you guys can still see it better. Now, if you look at this candlestick right here, where the arrow is pointing to, this candlestick exactly, if you look at the bottom side of the screen, you see where it says Tuesday, 14 January 2025, 9 a.m. So that means that candlestick pattern started at 9 a.m. and ended at 9:29 a.m. So that means that the market moved from this point right here to this top right here from 9 a.m. to 9:29 a.m. And then if you go to the next candlestick pattern, this one right here, you see at the bottom of the screen, it says 9:30 a.m. That means this market moved from this bottom to the top right here within 30 minutes. That's from 9:30 a.m. to 9:59 a.m. And then this next one started at 10 a.m. and so on like that. So you can see that each candlestick is showing you how the market is performing every 30 minutes. That's just the meaning of time frame. So if you're using 30-minute time frame, it's not telling you that you must end your trade after 30 minutes. No, that's not the right thing. So this is the meaning of time frame. Now we have different time frames for different kinds of traders. We have 3 main kinds of traders. We have scalpers, we have day traders, and then we have swing traders. Now for scalpers, I always advise you use between 1 minute time frame to about 5 minute time frame. So if you come to this time frame thing, just click on 30 minutes at the top. So for scalpers again, I advise you use between 1 minute time frame to 5 minute time frame. Or if you want to use seconds, I don't think seconds will give you any tangible analysis from your chart. So I would advise you start from 1 minute to 5 minutes. And in case you don't know who scalpers are people that they want to enter a trade and maybe they want to take their profit within a very short period of time. So maybe you are looking to make your profit within 2 minutes, 3 minutes, 5 minutes mark, or maybe even seconds. So those are the kind of people that are called scalpers. They just want to enter the trade and make tiny amount of profit within a short period of time. Those are who scalpers are. So again, for scalpers, I advise you use between 1 minute time frame to 5 minute time frame. Now, if you're a day trader, you should be using between 10 minute time frame to 4 hour time frame. So between this 10 minute time frame to 4 hour time frame. So you can use 10 minutes, 15 minutes, 30 minutes, 45 minutes, 1 hour, 2 hours, 3 hours, and 4 hours time frame. So if you're a day trader, that means you're the kind of person that you want to enter a trade today and you want to exit your trade within that same day. So you don't want to take your trade to the next day. That's who a day trader is. So day traders usually take their profit within 1 hour, 2 hours, 3 hours, 4 hours, depending on how the market is doing. I hope you understand. Now for a swing trader, we advise you are using between 1 day time frame to 1 month time frame, depending on how long you want to trade. So swing traders are people who maybe take a trade today and maybe they take their profit after 4 days, 5 days, 1 week, 2 weeks, and so on. Those are swing traders. So whichever kind of trader you are, these are the time frames you can use. And if you want to learn more about the best time frame to use to get consistent profit with your strategy, I have a dedicated video for that. I'll put the link to that video in the description below. So that's the third important arc you must understand. Now the fourth important task you must understand is your risk to reward ratio. Risk to reward ratio is something very, very important that everyone must understand if you want to do technical analysis and if you want to do futures trading. Now, what do I mean by risk to reward ratio? Now, we have different kinds of risk to reward ratio when it comes to trading. We have 1:1, we have 1:2, we have 1:3, 1:4, and so on. Now, what's the meaning of this? Now, let me put my risk to reward ratio projection on the chart, then I will explain it. Now, to do that on TradingView, just come right here to the left side of the screen. You see where you have this arrow, just click on it, and you see where you have long position and short position. Long position is if you want to long, while short position is if you want to short. So let's just assume we want to long for this tutorial. So I'll just click on long right here, and then I'll come and put it right here on the chart. So I'll put it on the recent candlestick on the chart. Now, what do I mean by risk to reward ratio? Now, if you look at this point right here on the chart, let me make it big so you guys can see it. Now, if you look at this point at the chart where you have risk/reward ratio, you can see it says it is 1. So it is 1 right here. Now, what this is telling you is that if you enter a trade right here and you put your take profit at this point, so this green point at the top, so let me make it smaller again so you can see. So this line at the top, this line right here, where this green is, this $97,024, this price right here, it means that if you put your take profit there, whatever amount you are making is what you also lose if you put your stop loss right here. So let me put an exact amount so that you understand. So let's, for example, you enter the trade at this point. This middle line is the entry price. So if you enter a trade at this point, and then maybe the profit you have to make at this point is, let's say, $500. What is telling you that if your trade enters take profit, which is this line right here, you will make $500. But if your trade does not go up to that point and your trade goes down against you to this point, this stop loss point, it means you will also lose $500. So that's the meaning of 1:1. That's why you have 1 right here. But what of 1:2? Like I said, we have different risk to reward ratios. We have 1:1, 1:2, and so on. Now, what of 1:2? So for 1:2, this risk to reward ratio that is 1, we change to 2. So for you to change to 2, you increase your profit. You increase your take profit right here. So then move it until we see 2. So you can see we already have 2 right here. So you can see it is 2 right here. Now, what is the meaning of this? What it's telling us is if you enter a trade right now at this middle line, if your take profit is at this point, and let's say your profit is about $500 if you get to this point, it means that if you get to this point, you make $500, and then if it doesn't go according to your plan and goes against you to this stop loss, it means you'll be losing half of that $500, which is $250. I hope you see. Oh, but let's say, for example, you want to use 1:3. So it is still the same thing. I'll just move it till that risk to reward ratio is 3. So just keep moving it. So you can see it right here, risk/reward ratio is 3. So what it is telling you is that, let's say, for example, you enter a trade right here again, and then if you move it, and then if your take profit is here and your stop loss is here. Now, if your take profit is here and let's say you are making like $3,000, It means that if it enters your stop loss, you'll be losing $1,000, which is 1/3 of what you are going to make. So that's the meaning of risk to reward ratio. Now, how is this going to help you? Now, let's say, for example, you're the kind of person that you want to make more profit than losses. Then you should be using at least 1:2 and so on. But the best risk to reward ratio I always advise people to use is 1:2. Don't be using 1:3, 1:4, 1:5. It's very risky. Anything above 1:2 is kind of risky, but if you are profitable, you'll be making really high profit. But how is this going to help you? Now, let me go to this website called winrate.io to show you how the risk to reward ratio can help you. So let's come to this website. This website is called winrate.io. Now let's fill in some details right here. Now the first thing they're asking right here is your starting balance, which is $1,000. So we're assuming we are starting our trade with $1,000. And then let's say our win rate is, let's say 50%. So that means we want to win half of our trades. So let's say we are taking 10 trades in a month. That means we are looking to win just 5 trades. And then your take profit to stop loss is your risk to reward ratio. So if you are using 1:2, that means that your stop loss will be 1, while your take profit will be 2. That's 1:2. If you are using 1:3, this take profit will be 3. If you are using 1:4, this take profit will be 4. That's just the meaning. But let's start with 1:2. So if you are using 1:2 with 50% win rate, and let's say you are taking 100 trades. So with 100 trades, it means that you win 50 trades and you lose 50 trades. We are just imagining that. And for the leverage, let's assume we want to use 10x leverage. I'll still explain what leverage is all about in this video, so keep watching. So once you've entered that, just click on Run Strategy. And you'll see that with 50% win rate and 1:2, you can turn $1,000 to $15,000 with just 100 trades. But let's assume you're using 1:3. So once you enter 3 right here, just click on Run Strategy. And you see that $1,000 will make you $68,000 profit after 100 trades. So what I'm trying to tell you here is that the higher the risk to reward ratio, the higher the profit you can make. But you must make sure that for you to achieve this, your win rate must be at least 50%. But even with 1:2, if your win rate is about 40%, let's put it to 40%. That means you are winning 40% of your trades, you will still be profitable because of the 1:3 risk to reward ratio. So if I click on Run Strategy right here, you see that $1,000 will still make you $17,000 profit after 100 trades. Let's see 30% win rate, whether will still be profitable. So click on Run Strategy. So you can see with 30% win rate, you'll be entering a loss. So that means that 40%, or let's try 35. Let's try 35. So click on Run Strategy. So you can see your $1,000 will make you $2,000 profit with a 35% win rate. So if you want to use this kind of strategy, just make sure that you're using the same risk to reward ratio for all your trades, and make sure that you focus on getting at least 35 to 40% win rate so that you can be profitable. So that means out of 100 trades, just focus on winning 35 trades, which is very possible if you have a very good trading strategy. So that's it about risk to reward ratio. So just come right here to pick your risk to reward ratio. So you see it right here. This is 1:3. So you can see right here, this 3 means I'm using 1:3. So if you want to set your stop loss, so for this trade, your stop loss will be $94,821, while my take profit will be $99,224. The price at the middle is the price at which you enter the trade. That's just the meaning of risk to reward ratio. And I hope you've been able to learn something new from this video. So if you're just learning something new in this video, let me know in the comment section below. Now to the last important hack you must understand, which is leverage. Leverage is something that a lot of beginners in futures trading don't understand, and it is making them to lose a lot of money. Now, what is leverage all about? Now, let me go to my Bybit page. Now, this is Bybit right here. So let me come right here to where I have futures. So let's go to futures, this futures right here. Now, this is the Bybit futures trading page. And if you come right here to where you have this 20x right here, if you click on it, you see that you have options of pricking between 1x leverage to as high as 100x leverage. Now, what is the meaning of this leverage? Now, like I always say, leverage can make you more money, and leverage can allow you to lose a lot of money with futures trading. Now, how do you use leverage? Now, let's say, for example, I'm using 10x leverage. Let me change it to 10x leverage. Now, if I'm using 10x leverage to trade, now this means that if I enter a trade and let's say BTC, let's say I'm trading BTC. Now, if BTC moves up by just 1%, that is the price of BTC, it moves up by 1%, and I'm using 10x leverage, it means I'll be making 10% profit. Now, how did I calculate that? It is the leverage you are picking multiplied by the percentage the price of that crypto is moving up. So that's 10x leverage multiplied by that 1%. So 10 times 1 is 10%. Or let's say, for example, the market moves up by 2%. If the price of BTC moves up by 2%, that will be this 10x leverage multiplied by 2, which will be 20% profit. So what I'm trying to tell you is that just because the market is moving by just 1% or 2%, I'm making 10% or 20% profit, which is huge. That is why some people are always greedy to select high leverage. Let me show you what I mean. So let's say, for example, I'm selecting, let's say 60x leverage. So if I'm choosing 60x leverage. Now, if the market moves up by 1%, don't forget, the profit will now be this 60x leverage multiplied by 1, which is 60% profit. Everybody wants to make 60% profit with just a 1% move. Everybody wants to do that, but that is highly risky. And that is what a lot of beginners are just looking at, and that's why they keep picking high leverage, which will eventually make them to lose all their money. Picking high leverage can make you lose all your money in some seconds. Trust me, it will not even be up to a minute or 10 minutes. You can lose all your money when you pick a very high leverage with futures trading. That's why a lot of people always focus on high leverage. If you have been watching my content for a long time, you know I always advise that you don't pick more than 30x leverage. 30x leverage is what I advise that it should be the highest, 30. Anything above 30 is too high. You can even see Bybit is telling you that this current leverage is too high. So you can see they're even telling you that 30 is too high. 30x is something that you should not go above anymore. Don't go above 30. You can start with 10, then 15, then 20, and 30. Don't go above 30. Very, very important. Now, I've explained how leverage can allow you to make more money. Now, how can it make you to lose more money? Now, let's, for example, you are selecting, let me say 60x leverage now. Let me go back to that 60x leverage. You know, I said if I'm longing and then it moves up by 1%, that means I'll be making 60% profit. But let's say, for example, it doesn't move up when I'm longing. It now moves against me. That means that, so if it moves 1% against me, that means I'll be losing 60% of my money. So you are calculating that percentage is moving down, multiplied by the same leverage. So that's 60%. That means that with just a 1% move, I've lost 60% of my money. That's almost everything. So you can see that picking a high leverage can help you to make more money, while also picking a high leverage can make you to lose more money. So I hope you've seen that picking a very low leverage is the best thing to do, especially if you're a beginner. So again, always pick between 10x leverage to 30x leverage. So these are the 5 important hacks you must understand if you want to make consistent profit with futures trading. Number 1, I said key levels, which are your support and resistance. Number 2, I said candlestick patterns. Number 3, I said time frame. Number 4, I said the risk to reward ratio. And number 5, I said leverage. Now, if you want to learn more about all of these 5 important hacks, you can register for my complete crypto trading course. The link to register for the course will be in the description below. You can see that the course is created by me, Femi Olaniyan. It is my course, and it is one of the top rated courses on Udemy. You can see it has 4.7/5 rating, which is very huge. So you can see you'll be learning the basics about trading. You'll also be learning fundamental analysis. You learn how to pick profitable coins to trade. You learn technical analysis. You learn different technical indicators and how to use them. You also learn price action and candlesticks. And under this, you learn trend lines. You learn support and resistance, which I just explained. We learn candlestick patterns. These candlestick patterns, I talked extensively about different candlestick patterns and how you can use them to trade. I talked about trading strategies and time frames, which I just finished explaining. In the course, you also learn how to generate signals by yourself. So a lot of people don't know how to generate signals themselves. So you learn how to do that. You also learn how to set your stop loss and your take profit right here. And you learn spot trading, you learn futures trading, you learn risk management. All of these things are the important things you need if you want to make consistent profit with futures trading. So if you want to register for the course, check the link in the description of this video. So thank you for watching, and I'll see you guys in the next video. Bye.